Transaction 4. Vehicles have a useful life of 5 years and needs to be depreciated using the straight line method. No residual value has been determined and this has not yet been accounted for. The depreciation has not yet been accounted for. Alright, so what is happening here? We are using our vehicle. Remember, whenever we're using something, we need to record an expense. So what's going to happen? Well, because we used an asset, alright, we're going to record an expense. Our expense is going to increase. Okay, we're going to calculate the amount just now, and because an asset specifically was used, my asset needs to decrease. So my expense is going to increase, my asset is going to decrease. Now whenever we use a fixed asset, as in this case is we're using vehicles, that is going to be referred to as depreciation. Alright, and you'll remember the way that we're going to decrease the value of the asset is not to directly record it against vehicles, but we're going to use an account called accumulated depreciation, specifically vehicles. Alright, let's quickly calculate the amount. Now the amount here, we've got a useful life of 5 years, which means that well, they don't tell us when we purchased this vehicle. Right, there we go, vehicles, total cost of 279,000 Rand, and they said we are using the, just quickly have a look here, we're using the straight line method. So straight line method, formula for calculating depreciation there is cost minus the residual value divided by the useful life multiplied by the number of months that we had the asset in use over 12. Okay, this is the number of months that the asset was in use in the financial year. Right, so let's have a look. What's the cost of my vehicles? Well, the total cost of vehicles is 279,000 Rand. So 279, what's my residual value? The information said that we do actually not have a residual value. It said here no residual value has been determined. So we can put a 0 here. Our useful life was 5 years. We used this asset for the full 12 months during the financial year because no other information was given. Alright. You can also see here, just something to note, that the date for the accumulated depreciation is the 1st of July 2012. Our year end is 30 June 2013. So this means this accumulated depreciation has not yet been updated, which we know already because this is what the information told us. This has not yet been accounted for. So the depreciation or the usage for the current year is not yet included in this accumulated depreciation figure, and that is why we need to adjust for that to include the usage. Okay, so if we take our calculator and we calculate that, we're going to get 55,800, and that's the amount that my expense needs to increase by and my asset needs to decrease by. Quickly, just let's look at our line items affected. Alright, remember 2 line items need to be affected. The expense is going to go on the depreciation line, which is in the income statement under operating expenses, and that is the depreciation line. Alright, and we can just put here under operating expenses, so that is the subheading that we're going to use. The asset is, well, vehicles. What type of asset is vehicles? We've got an option of 2. It is either a non-current asset or a current asset. Well, because vehicles are being kept in the business to be used in the operations of the business, and there's no real intention to sell off the vehicles as such, they are going to be classified as non-current assets. Now, vehicles is not a financial asset. It is in fact a fixed asset. What that means, it doesn't mean it is fixed, it can't move. It just means it's fixed in the business. There's no real intention of selling that asset. Alright, so the asset line item that we're going to use is the fixed assets line item, and that is under sorry, this is a little bit, that's under the balance sheet, under the non-current asset section, the fixed assets line item. Right, so if we go to my fixed asset, what needs to happen to the fixed assets? It needs to decrease. Right, by how much? By 55,800 Rand. So we're going to say minus 55,800. The reason it decreased is because we use the vehicle. So whenever we use something, we need to record an expense. So let's look and see. Where is my depreciation expense from the skeleton? We don't see it. The reason we don't see depreciation expense from the pre-adjustment trial balance is because the depreciation adjustments would not yet have been done. You can see that from the dates here on the accumulated depreciation. So that means we're going to have to add the depreciation under operating expenses. So there we go, depreciation. And we're going to increase our depreciation with the 55,800 Rand. Right, that is transaction number 4 done. Let's just double check. We've done our expenses that increased and we've done our assets that decreased. Good. Right, moving on to transaction number 5. Mr. Gonzalez, one of RE Vision Limited's debtors, was declared insolvent. His total debt was 2,500 Rand. Now, Revision Limited received 94 cents in the Rand from his estate. The remainder had to be written off. So what's happening here? Well, Revision Limited has got a debtor that owes them money. But now, because this debtor, Mr. Gonzalez, has been declared insolvent, Revision Limited is basically going to lose some of the money that was owed to them. So what is the total debt of Mr. Gonzalez? It is 2,500 Rand. So let's have a look here. The total debt for Mr. Gonzalez is 2,500 Rand. And we can represent the total debt by 100. Alright. Then the information tells us that Revision Limited received 94 cents in the Rand from his estate. So Revision is going to receive, or received actually already, 94 cents in the Rand. So if we calculate that, we can say this figure here is going to be 2,500 times 94 cents over 100. So we take what we need at the top and what we have at the bottom. Remember, the 2,500 is what we have, that is the total. The 94 cents is what we received in the Rand, right? And the total that we have is the 100. So if we calculate that, we're going to get 2,350. All right. So the question is, what is the amount that has been written off? So we basically wrote off 2,500 minus this 2,350. So that is going to give me 150. So the 150, how did we get that? It is 2,500, the total debt minus the amount that we actually received, 2,350. That gives me the amount that should be written off, 150. Alternatively, what we could have done is we could have said the portion, remember this is the portion or the ratio. Alright, we could have said the portion written off is the 100 minus the 94 that we received, which is 6 cents. For every 100 cents that this Mr. Gonzalez owed, we are going to write off 6 cents. So we could have said, or 2,500 times this 6 over 100, and if we calculate that, you're going to get 150 Rand. Right, so the question is, which line items do we need to adjust here? What is happening? Well, we're basically again losing an asset. Our asset is going down. The specific asset that is going down here is my, let's just put in a different color. We're losing an asset. The asset that is decreasing is my debtor's control. We had to write off, in fact, 150 Rand of my debtor's control. So, question is that a non-current asset or a current asset? Well, because debtors control will normally receive the money from them within the next 12 months. That is going to form part of my current assets. I'm just going to indicate that with a CA. And now my current asset is decreasing by 150 Rand. Now, whenever we are losing an asset or using an asset, we need to record an expense. So the expense is going to increase here because we're effectively losing this asset, which was a debtor. So we're losing 150 Rand of our debtors. And the account that we're going to use is specifically called bad debts. So that's the line item that we're going to use for expenses. The line item that we're going to use for the asset is called trade and other, not payables, receivables. Okay, remember receivables and debtors are pretty much the same thing. Alright, so my trade and other receivables line item is going to decrease, and my bad debts line item is going to increase. So let's go to bad debts. Again, we wouldn't have the bad debts line item because we didn't have that in our pre-adjustment trial balance, so that's not in the skeleton that we originally drew up. But now we've got it here, 150 Rand. Our bad debts increasing by 150, and my current assets is decreasing by 150 Rand because of the debt that I had to write off. Good. That was the first part of transaction number 5. There was another part here. Provision for bad debts is estimated at 9% of the total debtors book. So how do we go about this? Well, first thing we need to check is what the provision for bad debts balance is currently. So if I look at my pre-adjustment trial balance, I see the balance is currently 300 Rand credit. So I've got provision for bad debts. It's going to abbreviate that. 300 Rand credit currently. Okay, that's what it is currently. It should be, information says it should be 9% of the total debtors book. Okay, so it should be 9% of debtors book. Alright, so that is 0.09 multiplied by my debtors book, which is currently, total debtors is 25,000 Rand. Alright, but one thing we need to remember is that we have just written off 150 Rand from Mr. Gonzalez. There we go. There is my 150 Rand that I just wrote off from Mr. Gonzalez. That was the first part of our information. So if we calculate 0.09 of that, we're going to get 2236.5, so we can round that off to 2237, and that is what the credit balance should be. So the credit balance is currently 300, it should be 2237. So to get it from 300 credit to a 2200 credit, we're going to have to pass an adjustment. And the adjustment is going to be 2237 minus 300, and that is 1937. And that is going to be a credit to which account? Remember, we're dealing here with the provision for bad debts account. So it was currently from the trial balance, it was a 300 Rand credit. All right, it should have been from our calculation 2,237 Rand credit. So the adjustment to the provision for bad debts account is 1937. So that's the account that was credited. What is provision for bad debts again? Provision for bad debts is an estimate of the guys that is not going to be able to pay. In other words, it is an estimate of how much our asset is actually, how much of the asset we're actually going to lose. Alright, so my asset is effectively decreasing by this 1937. Alright, the specific line item that we're going to use is provision for bad debts, you remember, is the negative account for debtors control. Right, so the line item we're going to use is the same one as debtors control, trade and other receivables. You'll remember that debtors control is the positive account and provision for bad debts is the negative asset account. Right, but now because we are estimating an amount of the asset that we're going to lose, whenever we lose an asset we need to record an expense, because we're estimating that we're going to actually lose some of our debtors. So the account credited here was provision for bad debts. The account debited, you remember, is going to be, remember, for every credit there needs to be a debit. It's going to be provision for bad debts adjustment. Alright, important that you remember the word adjustment, because this word adjustment makes it a nominal account. Alright, if there's no adjustment here, that's going to be a balance sheet account, and that's going to decrease the value of my trade debtors. So don't confuse these two accounts. This is the nominal account. This one here at the top, provision for bad debts without the adjustment at the end, that is my balance sheet account. Okay, so the provision for bad debts adjustment is going to form part of the income statement, while the trade and other receivables is going to be in my balance sheet under current assets. So my asset is decreasing because the provision for bad debts increased, and my expense is increasing because we're estimating the amount of the asset, or the estimate of the amount of assets that we're going to lose increased. Right, so we assuming that in the future we will lose more assets, so therefore we need to record more expenses. Again, we didn't have this expense in our income statement before, so we need to record that here. Provision for bad debts adjustment. Remember the adjustment, otherwise it is not a nominal account. Alright, and the amount we had was 1937. Just quickly want to show you again. Remember the amount of the adjustment was 1937. Okay, there we go. Provision for bad debts increased. We're not done. Remember, for every debit there needs to be a credit, so we need to record under our current assets, our trade and other receivables is going to decrease even further by another 1937. Remember, we started off with our 300 Rand provision for bad debts adjustment. Now we're adding the extra 1937, and that is going to get us to our actual provision for bad debts, or what the actual provision for bad debts balance should have been. Right, that is the true picture of the amount of guys that we think, or the amount of money that we think we will not actually successfully recover. Okay.